Okay, folks, thanks for joining me today. This is being recorded, and I always mention at the beginning of all my webinars is watch this again, because some of the nuances that I talk about that I find very important to any option strategy might not be covered on somebody else's webinars. So please watch this again so some of those nuances will stick into your long-term memory. But ultimately, I'm here to get you folks to a place where these options just make sense. And have you guys ever heard of that man, teach a man how to fish, right? Yeah, that's kind of what I'm doing. I don't want to give you guys a fish. I'm not just sitting here and saying, hey, go out and buy Microsoft, stuff like that. What I'm trying to do is show you guys how to trade options so that you guys can make your decisions on your own. And I've geared this course to introduce traders and investors to options. And I'm sure even this old floor trader can teach the savviest of traders a thing or two. And I'm not going to, for you newer traders, I'm not going to lie, options can be intimidating, but I'm going to build from simple concepts to real life examples. And by the end of this, I'm sure you guys will have a solid understanding of options. My goal is to get you guys to a place where you know and understand options intuitively. And I think I can do that for you pretty quickly. So folks, you're here because you guys want to do better in trading, right? Obviously, you know, when we're talking about swing trades, we're going to be talking about options around swing trades. And swing trades don't always work out. But the beauty is when we use options with that, we can increase our probabilities of success even more so than just on a technical swing trade, all right? Swing trades are good for turning those probabilities in our favor, but we can even turn that table all the way around by using options a lot of times. So first off, we're going to be talking about swing trades using the short put, but ultimately we need to understand what a swing trade is. For some of you new traders, you might not know what a swing trade is. Well, really ultimately what this comes down to is a swing trade that is any trade that lasts longer than 2 days. Generally considered less than a year, maybe even 6 months, but it's 2 days or more really. And a day trade, the only difference is a day trade is during the day, folks. So let's try and look and see what happens with a swing trade. What is a swing trade? Ultimately, what happens is with stocks and ETFs, we have a tendency to see these underlyings kind of create ranges, if you will. And sometimes, you know, you'll see a bullish move like this, and sometimes, you know, sideways, right? Or bullish, or sorry, we already did bullish. Let's do bearish, right? So you could do bearish and say something like that, right? With a swing trade, you're trying to determine an overall direction, all right? Sideways, bearish, right? You're trying to figure that overall trend, the longer term trend. And then once you do that, you try and find the resistance where the market slows down on the upside and the support where it finds a bottom, if you will. Same thing on the sideways market. You want to find those resistances and supports, all right? So that's what we're doing throughout that. And then finally, you want to find what the pattern is within the overall trend, okay? So we can see that on this bullish trend here, we got a bullish trend, we have a bullish pattern within that trend. We have a bearish trend here, and then inside of that trend, we have a bullish pattern kind of coming in here, right? And then over here, we have a bearish pattern within an overall sideways kind of trending market. So that's what we're trying to do with like swing trades. Figuring out those support and resistances, that's pretty key. Finding that pattern within the trend is also something we want to be looking for. Now, what happens with swing trades? Well, a lot of times what we'll see happen is that underlying will be trending, you know, and like we see a bullish trend start to happen, and then it just drops out of bed, right? Or, you know, it's sideways trending and it pops above where we're looking for. So you will see those things happen where it will work, and then it doesn't work all of a sudden, and then people start getting like, all right, well, you know, and they may have waited for all this setup, and then it goes through, right? That happens with any type of swing trade, no matter what strategy you're putting around it. the beauty in this is options will allow you guys to stay in these trades a little bit longer. And I'll drill into that as we go forward here, because you don't always have to nail it just right. You know, real life example, like I said, we'll build from simple concepts. Those were simple concepts. Real life examples, we can see this underlying wants to stay pretty much within this area, right? So you could say that this is your resistance, this is your support level. We got a sideways trending market, right? Well, what happens? You look and see all of a sudden you got a nice, beautiful candle, again, setting you up for a nice swing trade to the downside. You get involved in a trade and it can pop right through. You know, we were looking right here and all of a sudden looking for, you know, a bit of a correction and it pops right through. So all swing trades don't work out, folks. I'm not trying to convey that. They do work out, as you can see, more often than not. You would have had great strike location and done very well on any of these resistance area or support areas throughout the time for the last 52 weeks. And then, of course, it can pop through. What we want to do, though, is if we were trying to short this stock any other way than using options, it would just be messy, okay? You're going to have margin calls probably. You're going to be a little bit more antsy as soon as it pops through, wondering where you should get your out in. All of those things are going to be going on in your head. And what that does is it breaks down us being mechanical with these trades. We have to think about it as probabilities. We have to think about it outside of the realm of money because we attach an emotion to money. So we want to clear that all out. We are playing this as a technical analysis setup. We're trying to play swing trades around that. And then we're adding another layer of probabilities of success on top of that by using these options. So in a situation like this, the best we can do is identify the trend, find those support and resistances, identify the pattern within the trend. All right. Sometimes it's going to break out like this and come back down. If you were in with the stock, you might have gotten stopped out. The beauty, like I said, with options is you can kind of stay in this for a little bit longer. So how do we swing trade? Ultimately, like I said, you've got this, folks. We've gotten the trend, the support and resistances, the pattern within the trend, right? But not all swing trades work, like we've showed, right? But what we're going to do is use a process to keep you guys staying mechanical, and that will give you ultimately the best entry points for these types of trades. And what we talked about, identify the trend. So identify the support and resistance, and then ultimately getting the pattern within that trend is what we're trying to nail with a swing trade, all right? Overall trend's pretty easy to figure out. Support and resistances could be a little bit of a gray area, but I'll show you guys different ways to find those using Fibonacci's and other things. And then identify that pattern. Look for different candles to set up for those types of moves. Now, I go into this stuff every single day on my daily market commentaries, guys. When I'm looking at trades, we break this stuff down as well. So, but why were we using options? Because you have better odds, folks. You have better odds than just going out there and doing the stock. Anytime you buy a stock or sell a stock, buy, shorting, whatever, your probabilities of success is 50-50. I'm going to show you how using options you can increase those probabilities of success even more so. But you have better odds, which is going to allow you to keep your powder dry and stay in this a little bit longer, because it's not going to hurt nearly as bad as if you were in the stock outright. And ultimately, you're going to have less risk on the table, all right? But know your risks as well, especially with this strategy. You know, if you're used to trading stocks, every option is equivalent to 100 of the underlying, folks. So if you do a one lot in the options, that's equivalent to 100 of that underlying stock, ETF, or whatever it may be. So if you are used to trading stocks in increments of 100, use a one lot, right? If you are a big dog and you're using 10 lots or 1,000 lot, then use the 10 lots, all right? That's kind of how you're going to gauge this. Don't go over. I don't care how sure you guys are of a swing trade or any type of directional move. Never go all in, all right? it will bite you in the butt. All right, just don't do it. Always stay, and that's another thing with being mechanical, is stay with your same tranche size. Keep your allocations to where you're comfortable. You have to be trading like you just don't care. All right. And if you add too much, your quantities get too big, you oversize or allocate to one stock, then you are going to be more emotional about it. You are not going to be able to stay mechanical. Everything is going to start breaking down. So keep it small, no matter how sure you are. Because we even showed you, even with something like this with IBM, where in the daily market commentaries, you guys have seen me talk about this trade for the last year, probably till I'm blue in the face, right? Well, it can go wrong, all right? It was working out the entire time. It went wrong, but it's come back. And I was able to stay in this trade. Now, this isn't for the short put. This is just for swing trade type setups. But using options allowed me to stay in this trade longer than I would have had I just gone out and shorted stock. I can assure you of that. My mentality would have been completely different. But that was a sideways move. We got a directional move. We can find the support and resistance, drawing these channel lines in there, support areas, right? We got resistance areas. Another thing is, when you're doing swing trades, a lot of times, if you are looking for it to cross the line, which is what you should be doing if you're doing stocks, it doesn't always happen. With options, it starts getting a little bit closer. I can use those options, still get great strike locations for this trade, which is going to increase my probabilities of success. If I can do this more often, then I can increase the amounts of times I can do it. That's going to increase my probabilities over time, all right? When you're just kind of throwing a dart at the wall, it doesn't always work out that way. So I was looking at this trade right here. It's kind of a messy pattern. We don't have a real discernible direction other than I would say it is looking pretty sideways at this point. Now, right here is kind of in the middle, and most people would probably say to look at this as a pass. But my idea here is that it came down, kissed this 50-day simple moving average, found support on that. Looks like it's going up and away. I really like that candle. We got the confirmation on the day after. Nothing's really happened here. Now, if you were in this trade on a swing trade and I went out there and bought the stock, I might be getting very frustrated right now. I got the confirmation, I got in, and then the next day it hasn't broken the pattern, but if this just starts trending sideways, I might not make money on this great setup here because it's just going sideways. And that's not something that's going to work out very well for a bullish assumption on a long stock position, right? So what we're trying to do with a situation like this is turn the tables into our favor, right? Get the probabilities, get great strike location, all of those things in our favor. That will allow us to stay mechanical. Because why? We are going to be looking at this as it won't be as an emotional trade, right? If you got in, say for instance, in this trade yesterday off of this setup, anytime it starts going below or underwater, you're starting to get a little nervous. Maybe I got in too early. But with options, you got that strike location. You got in at a good time. So most of this, especially with a trade like this, where it looks like it's confirmed going higher, but how can I increase my chances of success with this? A long call? Well, that theta decay might start eating into it. So all of these things I'm going to have to start weighing as I start looking at options. But we want to be able to spot the right option strategy. I kind of led you guys down that road just a little bit, give you a little taste before we start digging into this. Keep some of you guys that know options a little bit more interested maybe for a little bit longer. But let's go over some options real quick, just to go over the definitions for some of you newer folks out there. Call buyers have the right to buy that stock. They don't have to. That's why it's the right but not the obligation. So ultimately, when you're buying a call, you're buying a strike location. And if you want, you could buy the stock at that price of your strike, right? No, if your strike is way higher than the underlying is, are you going to want to buy a stock way up higher than where it currently is trading? Probably not. That's the beauty in the buying of a call, right? You have the right, but not the obligation. You have the option, if you will. Whereas then we look at the call seller, they have the obligation to deliver the stock or sell that stock to the person, all right? Selling, when you collect a premium for selling a strike, that means you have to deliver that stock at that strike location if the buyer wants to fulfill the contract, wants you to fulfill the contract. And the buyer has the right but not the obligation to sell that stock. So if you buy a put, that means at any given time, I can go to the person and say, you are buying this from me at that strike, okay? No qualms about it. They have to buy it. So obviously, if you bought a put that's way higher and you can sell it higher than where the underlying is trading, that is something you would want to do. You wouldn't want to sell it or use your right to sell the stock lower than where it's currently trading. That doesn't make sense, right? But on the flip side, the seller has the obligation to buy that stock, all right? If the buyer of the put says, hey, you're buying my stock from me, you have to do it, all right? There's no ifs, ands, or buts. It just gets stuck in your portfolio, folks, all right? So spotting the right strategy, we need to know, first off, we've got our directional assumption. I'm saying with BBY that it is bullish, all right? I've got a sideways trend. I feel like there's a bullish pattern within the sideways trend. So I'm looking to come up with a bullish strategy for Best Buy. But one of the things we need to look at is to determine whether our options over here, this is the Best Buy, our options, are these options cheap or expensive? Right? We don't know if they're cheap or expensive. I'm looking at this. What we need to do is take a look at this number right here. And that doesn't even tell us anything. But Vega is implied volatility, and it's forward-looking volatility. It tells us what the expectation is in the future of volatility, all right? So that's why it's really important. Now, back to my Best Buy chart here. This is where we were looking for that move to the upside. So I've come up with a bullish assumption, right? I've got that sideways trend, right? I'm thinking it's coming up here to test at least this area up here right around 124, 125, okay? So that is my thesis on this trade for a swing type trade. Now, what I want to do is know whether it is cheap or expensive in the option. So I have to take a look down here. Implied volatility, I've got a chart, and it is very similar to like a swing type trade as well. When you look at this as a chart, you can see that there are support and resistances in and around even this implied volatility. Yeah, sometimes it breaks out to the upside or the downside, but for the most part, it's going, every underlying has a range that it kind of wants to stay in, all right? And it is almost always a sideways trending market. Very often, you will have to look for that pattern within that sideways trend is what I'm getting at here. And what we can see is that volatility in this underlying was spiking. And I took this screenshot yesterday. It was really spiking. So that is an opportunity to see that we have, or that is where we're going to find that the premiums in the option montage are very expensive, right? When this line is at extreme levels, it tells us that the premiums are expensive. Why? Because volatility affects those premiums probably more so than anything else. Theta, we'll talk about here in a moment. The volatility at any given time fluctuates, and that is the biggest determining factor of how the pricing of the options is determined, all right? So when it is, implied volatility is at extreme levels for this underlying, we therefore know that the options premiums are expensive, all right? And when volatility is extremely low, we often know that those premiums are at the lowest levels they will be. So that means that's a buying opportunity, right? We want to buy low and sell high. It's just like in a stock, right? But let's zoom in on this implied volatility. I would like to discount what happened during the pandemic. All right. We've never seen that volatility since like 1984 and before that 1929. All right. So I don't think that we're going to see that anytime soon, more of a black swan event. So I want to discount that. Now, in our platform, or at least in TD Ameritrade, they will give you what the implied volatility percent is. But I have the code to show you how to do it to where it's just the last 6 months. You can throw it over there in the option montage, but we have that. If you guys want that, just reach out to us. But ultimately, we can see that there is a pretty good range bound. At these levels, it's pretty cheap, those premiums. Now we're looking at it being right here at the near high of what I'm looking at. And how we determine this is we take the current implied volatility minus the low volatility, implied volatility. Take that sum and divide it by the high minus the low. And ultimately what we're trying to do here is just really get the range of where the current is in relation to that high and low. Because we talked about that. Those really what we're doing is where are we now in accordance to our support and resistances? Are we at the near highs or are we at the lows, right? Same thing, right? You would want to sell near those highs and buy near those lows. So when we're looking at this, we can see that this number is at around 99%, all right? It's basically, we take the current 49.7 minus the low, which is looking at around 27, minus 27. And then the high, which is 50, minus the low, which is 27. So it's really up there at extreme levels, the higher levels that we've seen. So that's how you come up with where this current implied volatility is in that option montage in relation to where it's been in the past. Because if it's at these extreme levels, we would expect it to come back down. Now, if it comes back down, we could see this underlying trade sideways. And if that volatility comes out, that means our premiums dwindle, right? As volatility comes out, those premiums deflate with that volatility. So we could see this underlying just trend sideways. And if we were to sell with options in a matter of days with volatility, just we used to call it volatility crush, comes out, then you can make your money even if the underlying went against you. You could be directionally wrong when the premiums are really expensive and still make money, all right? Because we find that when they're expensive, we can sell those, and the underlying, we get a lot of things going in our favor, right? In the last couple of webinars, we talked about that thief in the night that comes and steals our premiums. Well, we know when premiums are super expensive, we want to sell those, right? So we are looking to sell options premium. Now we have to talk about that theta that we've been so worried about in the past couple of webinars, right? We talked about this. The thief in the night, it's not binary. It's not incremental every single night, like 2 cents, 2 cents, 2 cents. It slowly ratchets up and gets more aggressive inside of this like 35 days to expiration. That's the wheelhouse for selling options because you get that theta decay on your side. The theta is the thief in the night. Every single night comes and steals premiums. We talked about this. This is a buy zone. So when you want to limit that theta decay out there, but in here, when premiums are expensive, you want to sell when premiums are expensive. And if you're in the sell zone, you want to be inside of 35 days to expiration. Sorry, that was really messy. So limit theta decay. You want to go out in time. Theta really ramps up the closer to expiration. We want to take advantage of that. And if you don't want to look at it on a chart, we can look at it on something like the SPY, just as an example. Inside of like 23 days to expiration, you can see that the theta is 12 cents a night. Outside of 50 days, 9 cents. Outside of like 70 days, only 7 cents. So if we were looking at expensive premiums, we know we want to sell, right? Because they're expensive. What else do we want in our favor? Theta. So theta, if we want to take advantage of it, we want to get inside that less than 35 days to expiration is really what we're looking for. All right. Sometimes it's going to be 40, but as close to, let's call it 35 days to expiration is going to be your wheelhouse. So let's put this all together real quickly. Just a little quick review. We ultimately are looking at an underlying in Best Buy that we have a bullish assumption on. We don't necessarily go straight to the long call. We need to know are these premiums expensive or cheap? We look at that volatility coefficient, see where it is in relation to where this underlying normally has that range. All right. If it's at the extreme highs, you know that premiums are expensive and therefore you're going to be leaning towards selling options. All right. We have a directional assumption that's bullish. We know therefore that we would be leaning towards the short put because of these premiums are elevated, right? So the short put, one thing with the short put, we also talked about the short put spread, right? If you're worried about the downside, this is more of a higher risk strategy in regards to the fact that it has the unlimited risk to the downside, all right? It is basically like you are going out there and buying the underlying, kind of, that if you bought an underlying and it went to zero, that was what your risk is, right? Well, this is, if you sell the put, your risk is from that strike location to zero, right? So I'm going to get below where the underlying is currently trading already, but so my risk is limited even more so than going out there and buying a stock on any given day, right? If I went out there and bought the stock at 115 today and my strike location on a short put would have been 105, well, I've got a lot less risk than going out there and buying the stock, all right? Also, we're turning the tables even further in our favor by setting it up with a swing trade and then really rotating the table in our favor by using a short put, okay? And where's our strike location? You guys want the strike? You guys ready to get out of here? So if we're selling a short put, if we think of this as the put side, because they're negatives on this bell curve here, and this is the calls, right? And the puts, because they're negative. We can look at the standard deviation curve, the bell curve, however you want to look at it. Yeah, sometimes they're skewed a little bit. We're not going to dig into that whole thing, but ultimately what I want to do is look for a one standard deviation, all right? Because basically, this is a 16% probability of happening. If we looked at this as being the underlying today, Best Buy, right? Underlying is currently trading right here. This is another thing. If you bought the stock, it's basically 50-50 in a sense on being immediately right. Whereas if I sold the puts, I'm down here at a 16% probability. That means I have 84% probability of all of this happening. The underlying trading that way. That means the underlying could go down, right? And I'm still going to be profitable. So we can turn the tables, right, by using options, because when we decide to do this trade, if we bought the stock, that's going to be about a 50-50 probability. At the same time, if I were to sell those puts a little bit lower at that one standard deviation to the downside, that means I have an 84% probability of success. All right. Somebody's throwing it out there. Can you please tell us which strategy this is again specifically? Sorry, just joined. This is the short put. So we're going to be looking at the short put at around a 16% probability of a losing trade. Is really Delta tells us a lot of things. And let me go over this real quick. So Delta tells us the rate of change to our options premium. That means for every dollar this underlying moves, our premiums are going to adjust by that coefficient. But on the floor, we used to say this is data, right? Delta is data. It tells us all kinds of things. But most importantly, it tells us the probabilities or our odds. All right, or the odds of success, all right, or our odds. So if I'm selling a 16 delta, that means my probabilities of success are 84%. because delta also tells us not only the rate of change to that option's premium, but it tells us the probabilities of that option strike being in the money by 1 penny. All right. So therefore, if I'm selling a 16 delta, that means I'm selling, I only have an 84% probability of, or I have an 84% probability of winning, 16% probability of being 1 penny in the money at expiration. So we have better odds using this type of strategy. And we can increase those odds when we have high volatility. Why? Because as volatility expands, we are able to get that 16 delta, because as volatility expands in a trade like this, we kind of look at it like, you know, look at a bell curve here. It's like a bucket. All right. You got a bucket. And when it's normal, there's no water in it. But when the bucket gets full, this bell curve will flatten out like that. All right. Which means those same probabilities are much further away. All right. So we can get further away from where the underlying is trading because of volatility. All right. And as that volatility comes out, that bell curve or this standard deviation curve snaps back into normal. And therefore, our premiums would really be further out of the money, in a sense, for probabilities. Okay? Does that make sense? I'm hoping I'm explaining that. I'm trying to read a couple of comments while they're going, and I can't say all of them. All right, so the short put, we want to sell, and this is a 16 delta. Sorry, 16 delta. Right? And for some of you guys that are, if you're going to do this at a 16 delta, I will tell you, on stocks that are less than $50, it's going to be around 30 some cents. Don't do this short put for less than 30 cents, okay? Because it's just, you're going to be really tight to the market. You're going to have a tough time really making your risk reward work out for you. So I always like to go for a little bit more. Therefore, that means that if it's 16 delta and it's trading like around 30 cents, I'm probably going to lean towards maybe like an 8, closer to the money option, maybe a 18-20 delta, okay? So I'll always lean a little bit closer to collect that little extra premium. So for instance, in this one, you know, and again, I would rather lean towards the 17 delta versus the 14 delta if I had to pick them here. So I went towards that 17 delta for BBY. And you can see that volume coefficient, or actually this is implied volatility. I have on the delta thing wrong, but that's implied volatility at 54. Again, we need to see where that is in relation to determine whether or not these are premiums, or these premiums are expensive, or if they're cheap. We already determined that they're expensive, therefore we're leaning towards selling. Bullish assumption, we want to be looking at this put. Now, when we did the put spread, we were looking at this 36 delta and then, you know, buying one to define that risk. Now, a lot of times with that short put spread, because we need to collect that that width of the spread, a third the width of the spread when we talked about it. With this, we have better probabilities, believe it or not. And a lot of people get really nervous about doing naked short puts and stuff. This has a higher probability of success than the short put spread. Although you might feel more comfortable having that defined risk, your chances of success are much less with the short put spread than it is with the short put. And that's just probabilities alone, okay? So you have to weigh your risk parameters. And some of that has to do, I would say, you know, that I believe, I should say, that the 110 puts are lower risk than, say, a 115, 110 put spread, right? Because of the probabilities. Now, SEC and those kind of guys are going to say that's not necessarily true. But when you just look at it and you're staying mechanical, probabilities are the probabilities, folks. So if I have a 16% probability of being in the money, or a 36% probability or percent chance of being in the money, that's it right there. All right, so when do you get out? On this trade, what I'm looking for is, well, let's talk about the max price. profit. Max profit is that premium received. Your max loss as this underlying goes to zero, right? Because we have a short put. That means we are buying at that strike location. We won't have a choice necessarily. And the break even is that short put minus the premium received. But when do we get out of this? You saw my chart pattern. I had a chart set up. Actually, I'm going to want to use different colors, and this thing's going to, let's just try it. In color. And then we had a pattern that kind of looked like that. That gave me the go-ahead, right? I got a little frustrated, or it's getting a little frustrated because the underlying then all of a sudden kind of drops back down again, right? Then we saw this happen the next day, and then today it's something like this, you know, where it's just kind of starting to move sideways. Now, if I got into a long position on this, I'd be like pulling my hair out. It's not going in my direction. Now, if I sell a put down here, though, way down here, I have that comfort knowing I have a lot of outs. If this trades sideways, I've got Theta helping me out. He's got my back, right? Trade sideways, volatility usually comes out. That guy's got my back because if volatility comes out, those premiums go down. And ultimately, I can get out. I'm going to be looking to get out of this. If you are a newer trader, lower risk tolerance, 50% of max profit, all right? 50% of max profit is my out. All right, that's what I'm looking at. So on this one, I'm looking at a 76-cent collection of credit. I'm going to be looking to get out at like 35 cents, all right, if I had a lower risk tolerance. Now, if you have a higher risk tolerance, I would say in the option, anytime, never write it into the end of the day, but get out for about 10 cents, 10 cents to a nickel. That would be the bottom line. That's a high risk trader, all right, has a high risk tolerance, right? So use those kind of like as you're going along, trying to always increase your risk a little bit. I'm not saying go full boat or anything like that, but start out at like 50% of max profit, go to 60% of max profit, but stay mechanical, slowly, incrementally increase that. Don't just jump full feet in and say, hey, I'm selling this put and writing it to the end of the day. I don't even do that. All right. I never let anything go into expiration. If I can get out for 10 cents on any trade, I'm going to do it. That dime is not worth the risk of writing it out. All right. If you get that directional move, get out. And if it corrects again, you can get back in. Get in and out of them. All right. So 50% of max profit for a person that has less risk tolerance, and probably a nickel or a dime for anybody that has a real high risk tolerance. Now, for this trade also, I'm going to be looking for it to hit my resistance, right? If it hits the resistance area, the underlying's kind of, we've seen it, we have support, resistance, and I got one of these, right? This is going to be my target, right? It comes up and hits that resistance level, I'm going to get out. If it breaks below this line here, which set up my bullish move, that's where I'm going to get out. Now, a lot of people will look at this as if I got involved in this as a stock, you know, this could be your out. Now all of a sudden this is your out and this is your out, and that's fine. Yeah, you can move your stops up or whatever. But with this trade, I can just leave it, let it go, watch that theta decay work in my favor, especially if it's just going sideways. I'm not worried about a margin hog in my portfolio because it's just going sideways. This is working for me. All right. Anybody else have any questions? So get out when it breaks that pattern setup that got you in, right? The pattern setup within the trend. If it breaks that pattern setup, that's where you're out. For me, I got set up on this one. This is the bottom line. That's where I found that support. I got confirmation to the upside. I'm playing, right? Selling those puts. We can already see volatility coming out of this today in Best Buy, as a matter of fact. You can see the volatility is all the way back down to 32 when it was up to like 50. So that sideways trend, that volatility coming out, that theta working in my favor because I'm inside of that 20 some odd days to expiration, Though that's all working in my favor. You can see it's gone down from 51 to 30 something in that time. So directional moves not helping me on this, but the volatility, the theta is all helping me. So without any other questions, I'm going to throw this out to you guys. You guys have the Options Lab offer here. I'm throwing it out there in the chat window. So you guys have a hot link to that. If you're watching this on tape delay, just pause right now and punch this into your URL. You guys get access to basically everything, all right? You have all of the webinars I've ever done. You also get access to all of our private sessions. This is down to about 30 members now, so I can't take any more than those allotments. It gets a little overwhelming, so I try to limit that because I want to make sure that you guys that are taking advantage of this get the best experience possible, and I can't just do that with thousands and thousands of people. And with this, you get access to me. I'm going to be your mentor. Anything you guys want, you guys can have access to me on chatting about options, strategies, or market, any of that stuff, geopolitical stuff, I'll go into it. If I can't do it in an email, I'll make sure we get on a Zoom call or something like that. We'll take care of it, make sure everybody's clear before going forward. And I want to thank you guys all. Again, here is the link. You can take advantage of it. If you have any questions, comments, or ideas for future webinars, reach out to us at trading@protraderstrategies.com. That's all I got for you, other than please take a moment to pause the video, go over our disclaimer. We're an educational company. I'm not trying to get you guys to jump on BBY with me. I'm just trying to show you how, when I'm going through the charts, I come up with a directional assumption, how we spot the best strategy. And that's what I want you guys to be able to do as well. All right, so take advantage of this. Like I said, it's over there in the chat window, or you're going to have to punch this into your URL. And that's all I got for you guys. I hope everybody has a great one. Derby down this weekend. And if you can't take that, take it easy.